So yeah, let's wait just a minute or so, and we'll be starting. Today we have a lineup of great speakers. We're gonna have two speakers. We're gonna have a guest speaker. There are plenty of announcements that we're gonna do today as well. So I think it's gonna be extremely good meeting today. So really looking forward to it. And yeah, there are some announcements that we're gonna make. I would like also to take that half a minute or so to tell you all that it's been a great journey so far, and the amount of people is overwhelming who joined 0xPoland. We more than doubled the amount of people from the first to the second meetup. We more than doubled the amount of people who joined us. So it's really, really, really great. And yeah, I think without further ado, we're gonna start. So let me tell you, I'm Marek from EthWorks. We are organizing it together with Maker. And let me remind you why we're doing it. We want to build a lasting developer blockchain community here in Poland, but open to really anyone in the world. And we have a great media partners, CryptoDev.tv, Zrozumieć Bitcoina, who help us promote and who help in our mission to build a lasting community of developers, of blockchain developers. And it's gonna be our third meeting today, third meetup that we organized. We also had a workshop last month, a weekend workshop, and I'm gonna tell you a little bit more about it in a moment. And we're gonna have 5 more meetings this season, including today. We're gonna have a student workshops, and we're gonna have more weekend workshops, and we're gonna have a hackathon. So I wanna tell you that last workshop, there was a great amount of demand, and we had to, and thanks to Maker, we were able to do 2 groups instead of 1. So there were 2 groups, each was 10 people, all everyone showed up, so that's really great. And that was we were only able to invite half of the people who sign up. So therefore, we would like to announce that in top of student workshops that we start in just a few weeks, and another workshops in May, we're gonna do additional workshops in April that's gonna be led by the Maker team, so that anyone who would like to can join and start learning blockchain development. We also announced earlier that we're gonna do a hackathon in May. The dates for the hackathon has changed. It's gonna be similar time, but a little bit different because it's gonna be remote first. So it's gonna be fully remote hackathon that's gonna start on Friday, 21st of May, and we're gonna finish on May the 29th. And I'm happy to tell you that we're gonna have some great partners, some great sponsors. We already secured $25,000 for prizes, and I think it's gonna be much more than that because we just started working with our partners and sponsors to build this prize pool. So we're gonna have a great speakers, we're gonna have great workshops, and we're gonna have a great prize pool. So I would like to invite you all. Follow us on our social media, follow us on Twitter on 0xPoland, but also we just opened Discord, so please join us on Discord, and you can expect announcement of specific partners and prizes and speakers in upcoming weeks. And today, we're gonna have 2 presentations. There's gonna be introduction to DeFi by Bartek Rutkowski from EthWorks, who's gonna explain what the whole decentralized finance buzz is all about. And then we have a great guest speaker from Balancer, Alex van der Sande, who's gonna explain in particular what is the state of automated market making and why we should already go beyond that. So really great lineup. And without further ado, I will let Bartek start his presentation. Yeah. So yeah, I think we're ready. Bartek, are you joining us? Wonderful. Hi, Bartek.
Yeah. Hey, yes, great to be here. Yeah, so I think I'll take it from here. So introduction to DeFi. Today we're gonna talk about what this whole DeFi thing is all about. We've heard on the previous meetup something about ERC20 token standard. We've heard on the previous event something about coding debt. Now it's time to put all these pieces together and compose a bigger picture that will be actually useful and that will be actually bringing real value to this world, so we can utilize it and see why is it so important. So before I continue, I just want to mention that I'm not a financial advisor. Nothing what I say should be treated as such. And I know my excitement might sound like a financial advice, but it's not. It's not one. So it's only my private opinion about everything. Okay. So what is DeFi? DeFi stands for Decentralized Finance, and this is whole ecosystem of different sorts of projects that utilize smart contracts on Ethereum blockchain. Not necessarily on Ethereum. DeFi refers to all of the projects that deliver financial products across different blockchains, but it's mostly Ethereum these days, as Ethereum holds the majority of utilized liquidity, and the most devs create stuff on Ethereum blockchain. And as we can see, there is this aggregator of data, which is called DeFi Pulse. And that's a screenshot that I've made for a similar presentation that I was doing around 2 years ago. So 2 years ago, there were like some projects with some amount of USD locked inside. The total value locked in the DeFi was $500 million, and Maker was like a solid leader, and that was actually the only project that was kind of on the scene. And today, and that's actually the screenshot taken today, we have $37 billion locked in different DeFi projects, and Maker, which still holds the strongest position on the market, is not a killer. It's not a tyrant that holds everything. So it's growing rapidly. Like the tempo of growth is outrageous, and the ecosystem is really flourishing. Yeah. So what is this DeFi thing actually doing? We say decentralized finance, so we imagine some financial stuff. So let's start with the simplest example possible. Let's imagine simple banking. What is banking all about? We have our hard-earned money and we put it in a bank. We put it in a bank because we want it secured, and some time ago, we even used to pay for that, right? Because banks provide security. Banks can make sure that we won't lose our money, and we were paying for that. Some time passed, and the banks realized that it's nice to actually use this money inside because it can be lent, it can be utilized in some way that it brings profit. So we won't need to pay to the banks anymore, because the bank can make use of our money, so it can profit. And actually, it also brings profit to us, right? Because we deposit money into the bank and we receive some small portion of gains created with the capital that we have put in our bank. Sounds like a simple example, sounds like a simple truth that we put something in the bank and we get a little bit of profit. So I think it should be possible to do it with smart contracts on a blockchain using primitives that we discussed in previous months. So let's explore Compound. So first of all, we have some portion of DAI. DAI is a ERC20 token, like one of these we discussed a month ago, and one unit of DAI is always worth $1, around $1. And let's imagine that Compound is this sort of a smart contract bank, and we put these DAIs into the Compound. we put them into there, we deposit our cash into the bank, and we get some virtual number, which is, in this case, another ERC20 token, which just says, this guy deposited this amount of money into the compound. It's like, it represents our share in the whole pool of funds in the compound. And how this money, this token in the pool can bring any profit. On the other end, we have a guy that wants to borrow it. So he puts collateral, and because the value of the collateral is greater than the amount of the funds that we want to borrow, he is able to borrow the funds from the pool. We need to do that because we need to make sure that he pays it back, because his collateral is more valuable than the DAI he took. So he's incentivized to actually pay it back. After some amount of time, before that, I think it would be nice to make a comparison to the traditional finance, because imagine a mortgage, right? The collateral might be considered, for example, a piece of real estate. In normal case, you put the ownership of a piece of real estate, like you pass it to the bank, so the bank can hold the real estate actually, so you can borrow funds needed to complete the purchase. And then after some time, you pay back money and you truly become an owner of the real estate. And similarly here, you put Ether, for example, some sort of collateral into the compound, you borrow DAI, and after some amount of time, you pay the DAI back, or your collateral is taken from you if you are not willing to pay your debt back, and that generates profit. And that generates profit because that's, of course, not for free. And then the girl on the left side, who was first to deposit her funds, her hard-earned DAIs into the compound, can withdraw with a profit. Most of the profit goes to her, and some small portion of these funds is left in the compound pool, as compound is indeed not a charity. And this model works extremely well. It's extremely simple and works well. And now there's something I missed, because actually the guy that put the collateral into the compound also receives some token that represents his funds located in the pool, right? Because he also had to locate something into the pool, and then he should be able to withdraw it. So now we have an interesting case, because now we see that not only the DAI depositor can borrow Ether, not only Ether depositor can borrow DAI, but also DAI depositor can borrow Ether. So both of the sides can deposit something, earn some yield on top of that, and borrow other funds that are located in the pool. And now, how does it happen that these funds are not blocked forever, right? Because we have now the girl on the left who might intend to withdraw her DAI, and they are not there, right? So how does she do that? And on the other hand, there's a guy on the right side which might want to withdraw some amount of Ether, but it might not be possible because this amount of Ether is not present in the pool. So now we have this thing called utilization ratio. And utilization ratio says how valuable an asset in the pool is. So as we see, most of the DAI located in the pool are already utilized. So somebody borrowed them; they are not there, and that indicates the high cost of such loan, right? So high cost of such loan, on one hand, incentivizes more DAI depositors to deposit into the pool, so they can earn high yield, and on the other, it incentivizes borrowers to pay their loan back because it's just expensive. And we see similarly with ETH, only a small portion of ETH is borrowed, so it's not needed that much anymore, and we do not incentivize more people to put their ETH into the pool. But on the other hand, borrowing this ETH is not that expensive, so anyone can do that. Yeah. And as we now consider these two sides of the pool of the compound system, which is pool and collateral, we can actually see that it should be only one thing, only pool. People deposit stuff, whatever it is. They gain borrowing power because they can borrow against their deposit, against their collateral, and they can earn yield on top of stuff that they deposited. Simple and extremely powerful. Actually, I can tell you even more, and that might be only that will be only a teaser because I don't want to dive too deep into this one. But it's possible actually to borrow something from the pool without any collateral, but only in such a case if you do this for a very, very, very short period of time, and this period of time is only one transaction. So you need to borrow and pay back a loan in the same transaction. You need a special smart contract for that. And this is extremely useful tool that we cannot see in the traditional banking system, at least not available for retail users. And I think that we will explore it sometime later. But yeah, it's also possible. Synths. So we were talking about this compound example about different sorts of tokens, right? The ERC20 tokens, and there was this DAI. I was saying that one DAI is worth $1, but actually, why? Why is DAI worth $1? And actually, why anyone accepts DAI when anyone can deploy an ERC20 token, and it's like just a piece of code. So what is actually DAI? At the beginning, let's explore this synthetic asset like in depth. What's essentially a synthetic asset? So we are going to start with the simplest possible example, which is wrapped ether. Wrapped ether is an asset that solves one very painful problem of smart contracts. We have an ERC20 standard. All of the projects utilize ERC20 tokens. We have dozens, hundreds of different ERC20 tokens, while we have ETH, which has completely different interface. So whenever you create a system, like for example Compound, which utilizes both tokens and ETH, you can implement it for an ERC20 token, which utilizes 99% of the whole market, and then this one edge case for ETH, which is not an ERC20 token. So how to fix that? So apparently the easiest solution is to just wrap an ETH in a token, right? So you can put your ETH into the vault, and this vault, whenever you deposit into this vault, will give you exactly the same amount of wrapped ETH. This is like extremely simple, right? This is basically the code that's responsible for the logic of depositing and withdrawing. Whenever you deposit stuff, you pay some amount of ether, you receive proper amount of wrapped ether, and the other way around, whether you want to withdraw, you just create a transaction that will pull your tokens from your account back to the vault, burn these tokens, and return your ETH. As simple as that. And we have a lot of synths like that. This one is the purest, but this is kind of a synth that we can call a custodial synth. This is a synth. There is like one issuer of the token, one issuer of the currency, and this issuer guarantees that anytime you pass them your asset, whether it's Bitcoin or whether it's US dollar, they are gonna mint you proper amount of token representing the deposit. So you can take one Bitcoin, pass it to the wrapped Bitcoin issuer, and you will get wrapped Bitcoin on the Ethereum blockchain. You can deposit US dollar in a special account, and then you will receive USDC or TUSD on Ethereum blockchain. but still it's not DAI. What is it then? So far, we are discussing only tokens which are hard pegged. Hard pegged means that they are hard pegged to their origins. So they can always be one wrapped Bitcoin can always be to one USD, and especially one ETH to one wrapped ETH and the other way around, because that's such a very simple smart contract transaction. DAI doesn't work like that. So how does it work? DAI is a token which was introduced by the Maker Foundation, which was like the first great DeFi project. And the idea is like this. You put your ETH into a special vault. This special vault evaluates how much ETH you put in there, like in dollar value terms, right? So not like it's one Ether. It's like there is an Ether worth of $200, whatever. And then you can create an amount of DAI that is always lower than the amount of ETH inside the vault. So DAI is like kind of, let's say for now, it's like Ether-backed stablecoin, right? So it's a token, it's a currency that's backed by the value kept inside the vaults in different sort of currencies, like for example Ether. Like we had the gold standard, right? So some time ago, like each US dollar or whatever else was backed by some amount of gold put in the special vault, which was a bank. And now we have this. It's not the same. It's not the same. I know it works slightly different, but there are similarities. And after you create these DAIs, you can do anything with them, like literally anything. You can sell them, you can exchange them, you can keep them, you can do whatever you want. And then you need to pay them back with a small fee. This fee cannot be paid in DAI, of course, because like how can you get more DAI than you minted, right? Of course, you can buy these DAIs from somebody else, but then he won't be able to repay his debt, etc. So you need to pay the debt with, and you need to pay it back with adding some fee, which is expressed in the MKR token. And what happens if your debt is too large, like larger than the value of the vault? Like that probably won't incentivize you to ever pay it back. Or worse, what happens if the value of ETH drops down and now it doesn't actually cover the synthetic debt that you issued? So it's no longer backing these synthetically created DAIs. There is a mechanism for that, of course. It's called Collateralization Ratio. And this is like a kind of red line. It's simplified here. It's simplified, but I think it explains the rule. It's a line that's drawn between the value of ETH and between the amount of DAI. And whenever the value of ETH drops down, so these values are met, the system says, okay, whatever, take your DAIs. We don't want to see them anymore. It's your problem now. We take out your ETH, we'll sell it on the open free market. We will buy DAI from someone else, and we will repay your debt. And basically, your vault is closed. Your debt is neutralized because we will repay DAIs from anyone else on the market. You will still manage to keep some small portion of ETH that was left for you, but generally your position is liquidated, right? Because system needs to be sure that all of the DAIs are backed by Ether. The other way around, if your debt raises so high that this ratio is met, the same will happen. The vault will be liquidated, the Ether will be taken out, will be sold, and you will just get the rest, and you can keep your DAI, and you don't need to repay the MKR debt anymore. But what happens if it happens, what happens if the situation is so rapid that within minutes or within like a 1 block period of time or whatever, like really quickly, the value of ETH drops so badly that the system is not able to react, right? It happened. It actually happened one time. I'm not sure if it was only once, but once for sure, March 2020. And in such a case, the maker system will print new MKR tokens to cover your debt. So, and that worked. So you can be sure that every DAI is always backed by Ether. This is one of its strengths. There are more, but yeah. So to summarize, make sure that your DAIs are always covered with proper amount of ETH, and the vault is safe. And actually, what's interesting, this can be done with other types of collateral as well. So you can, for example, put your Bitcoin into the vault and then borrow against that. So you don't need to actually sell it to use its value, right? You don't need anymore to necessarily sell the currency, cryptocurrency, but you can lock it, borrow some DAIs against it, and then just repay them, use them in a way that you would like to use them. And in the future, that's not true at this point. This is like future, probably. Maybe at some point you will be able actually, for example, to get a mortgage on blockchain, right? Because you need to lock like a tokenized real estate into the vault, and then you would be able to issue some amount of DAI that will be able to help you complete the purchase, for example. That's future, I guess. What can it be used for? Like this whole thing, because like now I showed you like two simple primitives, which is like one is like pooling stuff into like putting stuff into one pool and then borrowing and then paying interest, and now issuing a synthetic asset which is backed by some other asset, because it sounds like it's very like what can it be actually used for, right? So let's take an example. You can create a leveraged token. So for example, you can put Ether into the vault, mint some DAIs, then sell the DAIs for more Ether, put this Ether into into another vault or into the same one, whatever you prefer. Then you can mint more DAIs, buy more ETH, etc. Like create this leveraged position. And then at the end of the day, when you have, like at the very beginning, you had like $200 of worth of ETH, but then when the price changes, like you get more. Of course, it's dangerous, because if the price of ETH drops, then you can then you get less. But what's powerful here is that it's not trusted, right? It's not like there is some sort of central authority that allows you to create or use this kind of product. That this is something that's naturally created on top of blockchain. This is something that's fully automatic, that makes sure that everything will be fully backed, repaid, and properly managed, and you can be sure that it all works well. You can do shorts. You can, for example, put DAIs into the compound pool, borrow ETH, sell it, and then when the price of ETH drops, rebuy it for a cheaper price, take and keep the rest of the DAI. Of course, the other way around, you will lose, but that's how market works. And here, there won't be like any stopping the market and like deciding that it's volatile and dangerous. You should be doing more. You can whatever you think is okay, whatever you think is not risky, not too risky for you, and there is no one to stop you. If not the smart contract logic, which is always making the final decision on what can be done and what cannot be done. And the other thing is just you can actually buy stuff with these mechanisms, right? Because, for example, believe me or not, but there are some people that consider their cryptocurrencies their wealth, and they do not actually intend to sell that ever, or not in the near future. So if you want to buy something, you can actually put your cryptocurrency into the vault, issue some DAIs, and then, for example, hope that your debt will be rising slower than the value of your ETH, which might happen, might not. You can repay it. You can actually use the value of your currencies without getting rid of them. Or at some point, you can just liquidate the vault itself with a flash loan, right? So I will explain that sometime in the future, I guess. But that's also what's on the table. Is there more? There is. There are dozens of different kind of things. So, for example, there are decentralized exchanges. It's always very controversial topic, like the decentralized points of failure, right? The stories of the cryptocurrency exchanges that were failing, and they were closing the markets, or they were just disappearing. This problem doesn't exist anymore if you are using proper tools. There are products that allow you to exchange stuff on chain without there is, of course, a risk, the protocol risk that something will fail or the whole blockchain will disappear, but it's like significantly less risk than using a centralized exchange. So yeah, and you can also like compose stuff that utilizes these exchanges and perform some automatic operations. I won't dive deep into the decentralized exchange kind of topic, because we'll have a presentation from Alex, and he will explain everything. There is yield farming, which is like a very trendy topic these days. So I wanted to mention it and more or less explain what it's all about, because probably if you are completely new to DeFi, then you probably haven't heard about it. That's fine. But if you are not new to DeFi, then you probably heard that. So what it is? We had this simple compound example, right? There was someone with some amount of DAI tokens, which were located to the compound pool. The C DAI were issued, and this depositor was earning some yield on top of that. So this is the simplest form of yield farming, right? It's not very sophisticated, but it is one. And let's stick to the compound. So because actually compound probably was the first one to create a product that created the term of yield farming, because they started adding a comp token. So the active users of the compound protocol were allowed to claim some small amount of comp token. Comp is like a internal compound governance token, which empowers you to take decisions about the future of the protocol. And what happened? Apparently, the comp token was so valuable that it was okay for you to not only deposit your DAIs into the pool, earn some interest on your DAIs, and also earn the comp tokens. Actually, it was profitable for you to deposit DAIs and borrow ETH, then deposit this ETH again into the pool, not repay it, just deposit it again. So you have like more deposit, right? You actually like this deposit is like is losing value because you're both lending and borrowing at the same time, which like you cannot profit from that. But this small amount of COP tokens was compensating that, and it was worth it. And then you have borrowing power from the C ether that you have. So you borrow more DAI, and then you convert it to the C tokens again, and you again borrow more comp. You acquire more comp. And apparently that was pretty scary moment, because lots of people were thinking that it's gonna blow up and there's gonna be disaster, but there was nothing like that. It's not that profitable anymore. However, it's still like the using compound is profitable, but these crazy things are not that profitable anymore, and that's how it was. How it was all proceeding, let's say. And now all different protocols are also having their own token, which is used for something, and that's supposed to bring value to their holders, so people can actually do something interesting. And here we can ask a question about the comp token itself, like what is it for, right? Because like it shouldn't have any value at the first glance, right? Because Ether is the cryptocurrency. Some people are even at this point of time still asking questions whether cryptocurrencies have value at all. So that's one thing. Then we have these DAIs, and if we consider Ether to be valuable, then probably we should also honor DAIs and their value. But what is a comp token? Yeah, apparently there is this powerful governance thing, which actually makes DeFi really decentralized. So whether anyone wants to change anything in the compound protocol, people that hold comp token decide whether this is a good option or not, and they vote whether they want to this improvement to go live or not. And that's essential, because there's like no central authority. Of course, not every project is starting from this point. This is when the projects evolve and develop, they are moving towards this decentralization, and they start probably with an owner, but then at some point they gain some traction, they gain some group of dedicated users, they have a community. And then this community actually governs the protocol, and that's very important, because how do we know that these random people from across the internet will know what's good for the protocol, right? Or will have good intentions, right? Because we are actually now, like, for example, the creators of Compound actually passed the ownership of their child, of their company, to random people across the internet who can do anything. Why would they act in a way the Compound Foundation wants? Because by holding this token, they expose themselves to the success of the compound, right? So the value of the comp token will probably go up if the compound is doing well, if compound is successful, if it's aggregating a lot of fees, if it's just prospering, and will decrease in value if compound is not doing okay. That's a similar thing to the MKR token, for example. These holders of this token are really interested in the protocol doing well. So we actually have a system of really healthy incentives for random people from all across the world to cooperate and to democratically make a solid, reasonable decision. And here's no place for populism or pure politics. It's pure meritocracy, where the facts and the best ideas are the ones that are picked, and these decentralized protocols are actually doing extraordinarily well, right? And there are like plenty of other things. There are NFTs, which are digital art. So you can combine. You can have like a unique object, like piece of art or anything else. You can put it on a blockchain and you can put it up for sale. There are options, because I'm now leaning towards the end. Actually, at this point, if you have any questions, you can start thinking about them, because there's gonna be a Q&A session at the end. So there are options. So fancy things, fancy instruments for the pro traders, pro investors. There are indexes. So for the less pro investors, if you don't want to pick any one particular token, you can buy like sort of an ETF which aggregates a lot of tokens inside, and for example, allows you to buy a whole sector, not only like a particular one random cryptocurrency that is gonna succeed or not. You can just spread the risk. There are insurance protocols that allow you to buy insurance for your smart contract investments. So for example, when the smart contracts are when there is a bug in smart contract, which happens, then you can get some sort of refund from this protocol. And actually, that's very fresh situation, because there was some sort of an attack on one of the protocols recently, and the insurance went extraordinarily well, and people that were using it actually took no loss, because they were just insured. There are plenty of other things. I think it's not a bold statement if I say that here on Ethereum blockchain, mostly, I don't want to exclude other blockchains, but I'm mostly focused on Ethereum blockchain. It's like the closest to my heart. We have sort of Internet of Money effect arising. Ethereum is not a product itself. It's even probably not a platform. It's like a transact medium that allows new creators, new inventors, new startups to build all sorts of new things on top of what's already existing. And I think it's really exciting, and I think it's really worth learning, and it's really worth building. And yeah, I hope that you got interested. And I hope that you're gonna decide to learn more, because here what we saw was just like a tip of the iceberg. It's just like the first sip from the very tall glass of DeFi. And I recommend you to dive deeper. Okay, thank you for your attention. And if you have any questions, then I'll be really happy to answer them.
Hello back. Great to see you. Let's wait and see if we have any questions. Let's give it a couple moments. Here comes the first one.
Okay, I see the first one.
Yeah, Bartek, I'm gonna read the questions and you're gonna answer. How does that sound?
Okay. So does Maker have a plan to create tokens pegged to other fiat currencies or other assets, example gold? I'm not aware of such plans. Probably, of course, the people from Maker Foundation would be the best to answer. But what I know is that there are plenty of other products that issue other fiat currencies. We have at least two types, two separate synthetic euros. On Ethereum blockchain, there is the Trust token company which issues true Hong Kong dollar, Australian dollar, Canadian dollar. there are probably more to be found on the synthetics. When it comes to Maker, I'm not aware, but there are plenty of other projects that do that, and Gold is also available, at least in 2 different flavors, because I've seen it. So if it's Maker, I'm not sure, but definitely this is something that's present.
Yeah, I think definitely more than 2 gold stablecoins. Yeah, plenty. I heard the rumors that Maker is indeed planning more currencies in the future, but that is not official information by any standards, by any means. I think we have at least one more question. Let's see if it's coming. If it's not showing here, I'm gonna read it aloud. Can I? It was asked by David Sech on Facebook. Can I use Compound Governance Protocol to govern my DAO?
So it depends what's the question exactly about, because I can see at least 2 ways to answer that. So, for example, what you can do, you probably can fork the compound governance smart contracts and implement systems similar to theirs. Because it's open source. It of course has some sort of license, but it's public to some limitation, and you can like implement mechanisms that will work similarly. That's one approach. The other, if you're for example creating some compound related product, you can create smart contracts in a way that holders of the comp token will not only be able to govern the compound protocol, but also your protocol. Yeah, I think I don't know how to approach this in a different way. Maybe I'm gonna read it again just to make sure. Yeah, generally, if we are talking purely about the protocol itself, which is like basic primitives and basic mechanics and the smart contract design and architecture, etc., I think that you can utilize these patterns in your project as well, and it might work. Of course, you need to probably first have a community and find a way to distribute these tokens, etc. This is the hardest part. I think that creating the protocol is probably the easiest at the end of the day.
We have one more question coming. Again, I think there's gonna be. I think we have more questions coming. So let's take this one first.
Okay. Yeah, so do you think we'll see financial NFTs in the near future, and what it will do? Yeah, I was actually brainstorming this topic some time ago. I think that we will see more NFTs use cases coming. So right now they're almost exclusively collectibles and digital art, which is like probably for a very narrow audience, and not everyone wants to get involved into that. But I think that there are plenty of usages and use cases for NFTs which are not related to any sort of art. For example, at this point, some transactions on synthetics that are not atomic and that do not complete within one transaction mint you an NFT, and this NFT then allows you to claim the result of that transaction. So that's one thing. The other is, I think that we will probably see some sort of ownership proxy created with NFTs in the future, right? Because right now there is like one owner of a Maker Vault, for example, and I think that in the future we will see an ownership of a Maker Vault as an NFT, and then you can, for example, pass this ownership of Maker Vault to anyone else, or you can pass it to the protocol, and you can actually build on top of that. Also, there is Alpha Homora, which allows you to create leveraged yield farming positions, and they are all unique because you cannot participate in Alpha Homora like in very like kind of like crowd sale type of thing. So it's not like one pool. Every position is unique, and everyone needs to like create and maintain own position similarly to the maker vaults. So I think that this position also shouldn't be owned by addresses. Probably they should be some sort of NFTs. And I think that a lot more are coming, and like anything that is non-fungible in a very high level way will be tokenized at some point. I don't know if that answers the question. I hope yes. If you want me to leak some real alpha then I'm afraid I don't have like killer app ideas for NFTs at this point, but I think that they will be seen in a lot of projects, and they will be very useful
in the future. I think we have a few more questions. Let's take one more and push all the other questions to the networking at the very end. So let's see if we can see the next question.
It's gonna be short, so we can take two. But no, just kidding.
I'm waiting to start his presentation, so let's not generate a delay. I think the other question was on Discord. And thank you for introduction to DeFi. Could you tell us a little bit more about real use cases? We are a company that is purchasing insurance claim with a fiat currency, and we would like to explore where DeFi could be potential for financing this instrument. So real use cases, real insurance claim that is bought with fiat currency, and what are the possibilities in terms of DeFi being a way of financing real life insurance claims?
Okay, so that's a tough one. That, of course, I think depends on the level of decentralization that you want to have in your product at the first place. Because probably if there's gonna be like one central authority that's gonna, for example, decide whether the claim is rightful or not, then it's gonna be like. Then I'm not sure if it's gonna be like a perfect fit for a decentralized solution. But generally, I think that the whole like insurance industry, like as a whole, might move to DeFi at some point. Actually, this is like really complicated question. Yeah, I think it might be worth to take it offline to the networking session, because there are like plenty of different things. Maybe I'm gonna finish with a statement that I think it makes sense to move insurance products to DeFi, even if they are bought with fiat money, like at the retail consumer end. But it heavily depends on the exact use case.
I think to summarize, I think there are definitely opportunities, but that haven't been tried much so far. And that is connecting blockchain virtual space into physical. So that is not that much explored, although we see first loans that are kind of there. So there's, for example, the startup called TrueFi that we would know a little bit about, and especially Bartek, and who was involved in creating this. And the idea is that you have a DAO, and there is a voting, and the person who is borrowing needs to be approved by the DAO. So it's like one of the first working. I think they actually have tens of millions of dollars already there in the pool. So it's the first working with reasonable capital kind of use case. But that is a new use case. This is a new thing. This is like 2 months old. So this is going to be happening this year. So then the question is, are you want to be a frontier? Because if you do, that's perfect. if you want to look at other people actually doing it before doing it yourself, then it might be not perfect timing for you yet.